Many of you have recently asked me what I thought about Realty Income's latest results. It seems that a lot of you are curious because I just recently posted a controversial video in which I explained that I had decided to sell my position in Realty Income because of 5 key reasons. In short, I think that the portfolio quality of the company has deteriorated. Then secondly, the company is getting too big for its own good. Then I think that it has lost its focus in a way because now investing in many different property sectors. Fourth, then its cost of capital is too high for it to grow externally. And then finally, I just think that some of its close peers today offer better risk to reward. Even then, I still concluded that Realty Income is likely to do relatively well over time, delivering high single-digit total returns to its shareholders. But since my capital is limited, I need to be selective, and I just think that some of its close peers like Agri Realty and Essential Properties Realty Trust are likely to do even better going forward. So what did I think about Realty Income's latest results? Were they good or bad in my eyes? And importantly, do they change my perspective on the company? Hey everyone, this is Yoshi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to explain to you why I thought that Realty Income's latest results were very good news for its shareholders. But before that, I want to remind you that we're about to hike the membership rate of our REIT newsletter, High Yield Landlord. So if you wanted to check out our service, now is your last chance to secure our discounted rate. We're also offering a 2-week free trial, so there is no risk in you giving it a try. So why do I think that Realty Income's results were so good? It really comes down to one thing, and it is that Realty Income is now really embracing its new focus on riskier, higher yielding properties, and this is allowing it to earn a better spread over its cost of capital. Here's what the CEO of Realty Income said on their most recent earnings call. During the first quarter, we invested $598 million at an initial weighted average cash yield of 7.8% across 3 property sectors: retail, industrial, and data centers. Over half of this volume, representing approximately $323 million, was invested in Europe and in the UK at an 8.2% initial weighted average cash yield. And this is really good news in my opinion. And especially so in Europe, because they were able to get an 8.2% cap rate in Europe where interest rates are even lower, and so they're now able to return to external growth since they are finally able to earn a decent spread over their cost of capital. Even despite being discounted just like the rest of the REIT market, their cost of equity is today just around 8%, and if you add a 35% LTV to that with a roughly 5% interest rate, you get a weighted average cost of capital of right around 7%. Last year, Realty Income's average initial cap rate on its new acquisitions was just 7.1%, and so if its cap rate remained at that level, there essentially would be no spread today, especially after you account for some bad debt and some additional expenses. But with its acquisitions now back at an 8.2% cap rate, Realty Income is now once again earning a roughly 100 basis point spread over its cost of capital, even possibly a bit more, and therefore I think that we could see its growth now accelerate going into 2025. And this is obviously great news because higher growth means higher total returns for a net lease REIT like Realty Income. The company actually has an interesting slide on their investor deck that shows that their total return is essentially 3 components. It's their yield, their internal growth, which is a combination of their reinvested retained cash flow and their lease escalators, and then there's the external growth, which comes from raising new capital to acquire new properties at a positive spread. And so if you had asked me now just a month or 2 ago, I would have told you that there would only be the yield and the internal growth for Realty Income going forward because it wasn't able to earn a spread over its cost of capital, and so that would have led to a high single-digit total returns of 8 to perhaps 9%. But now with its spreads returning to a more reasonable level of about 100 basis points, we could see its total returns also improve going forward. I think that Realty Income's management team deserves credit for being willing to adapt their investment style to their now higher cost of capital to be able to maintain their growth rate. As surprising as it may sound, Realty Income is now actually getting higher cap rates than even Essential Properties Realty Trust, which has historically been the net lease REIT that will get the highest cap rates in its property sector because it's focusing on riskier middle market tenants. In the last quarter, EPRT had an average cap rate of 8.1% versus 8.2% for Realty Income. And that's really a first because historically, EPRT has typically gotten 100 to even 200 basis point higher cap rates than Realty Income. But while this is good for growth in the near term, I think that this information also confirms once again that Realty Income is now stepping away from the higher quality segment of the net lease market, which typically trade at lower cap rates, and starting to focus much more on the riskier and higher yielding segment instead. This is a bit of a double-edged sword because on one hand it will accelerate growth, but on the other hand it will also lower the average quality of the portfolio, increase risks, and likely lead to a lower valuation multiple over time. In the past, Realty Income used to focus on the highest quality properties in the net lease segment of the market, just like its close peer AgriRealty, and for this reason the market would price them at fairly similar FFO multiples, typically towards the higher end of the net lease peer group. But that's not the case anymore, and as I explained in my previous video on Realty Income, I think that many of its recent acquisitions, such as the one of Spirit Realty Capital or YCHARTS, or even now these acquisitions that's closing at the moment at a cap rate of over 8%, have lowered the average quality of Realty Income's portfolio, and the market has been smart enough to recognize this, and as a result it's now pricing Realty Income at a discount relative to AgriRealty. This now reminds me that when Realty Income announced that they would acquire Spirit Realty Capital last year, back then the CEO of AgriRealty commented on a post on Seeking Alpha, and what he said is that they would never try to acquire Spirit Realty Capital because of the low quality of their assets. And to be clear, that doesn't mean that it was a bad acquisition for Realty Income, but it just shows you again that they have changed their focus. They're not focusing on the premium segment of the net lease market anymore, just like they used to. Instead, they're now going after higher yielding properties. And this is also well reflected in their portfolio characteristics. If you compare the percentage of revenue coming from investment grade rated tenants between Realty Income and AgriRealty as an example, Realty Income is about 35%, at AgriRealty it's about 70%. So there's a very drastic difference, and the difference wasn't that big in the past. So all of this just to say that it seems that Realty Income is now really embracing its new focus on higher yielding properties, and it's a change that I welcome. I think that makes sense for them because their cost of capital is quite a bit higher than some of their peers, and they need to make this change to keep growing externally. My conclusion here is that this is a positive development for Realty Income, and now less pessimistic about its future growth prospects than I was just a couple months ago. However, I'm still not buying the stock because I continue to think that some of its close peers offer better risk to reward, and AgriRealty is perhaps the best example here. AgriRealty is, in my opinion, a much safer REIT because it owns higher quality properties that generate a much higher percentage of their revenue from investment grade rated tenants, and on top of that it also has a much stronger balance sheet with less debt. I'll put a table on the screen where you'll see the difference, but from the top of my head I think that Realty Income has an LTV of about 35% and AgriRealty is at closer to 25%. And on top of that, importantly, AgriRealty has no debt maturities for years to come, whereas Realty Income has many of them in each of the following years, and so it's going to be more heavily impacted by the surge in interest rates. And then the third thing that increases risks also in the case of Realty Income is its big size, as I mentioned in my previous video. I think that this is going to lower their ability to be selective about future investments, which will continue to lower the average portfolio quality, taking more risks. And so overall, I think that AgriRealty is a better REIT from a risk perspective. It's quite a bit safer. However, despite being safer, I still expect it to be more rewarding in the coming years because it's a much smaller REIT. So the new investments really have a big impact on their bottom line, and they are earning better spreads over the cost of capital than Realty Income. Even then, I still think that Realty Income could make sense for a small subset of investors who are looking to maximize safe income and really don't care about growth or total returns. But for the vast majority of people, I think that AgriRealty just makes more sense because it's a much better deal to get 100 basis points less dividend income and 300 basis point higher total returns in the end. That's roughly by how much AgriRealty has been outperforming Realty Income over the past 10 years, and I just don't see any reason why this outperformance would end anytime soon. Now, let me know in the comment section below what REIT I should cover next. The earnings season is well on the way. Most REITs are now reporting their earnings. If there's one specific that you would like me to cover, let me know below. Also, if you want to support my channel, I will appreciate it a lot if you click the like button, subscribe to the channel, and then finally, once more, as I said earlier in the video, we're about to hike the membership rate of High Yield Landlord, which is my REIT newsletter. I think that the hike will happen on the 1st of June. So if you want to secure our discounted rate, now is your last chance. There is a 2-week free trial. I'll put a link to it in the description of this video. Thank you very much for your support and see you at my next one. Bye bye.